In this month's case study about the power of the all-in-one loan, we explore if it can make sense as a replacement for a low-rate mortgage. 3 years ago, this couple refinanced into a mortgage with only 3.5% interest rate. But they realized, even at that low rate, how much interest they were going to pay over that time period. They were in a position that they were going to start paying an extra $500 a month to principal to save money, but they were concerned about tying up those funds. That's the beauty of the all-in-one loan. It uses funds efficiently to pay down the mortgage faster, and yet you don't lose access to those funds. On the right, you'll see their strategy to pay $500 a month extra was going to get their mortgage paid off in 20 years instead of the 27 years left without the extra payment. But going that route is risky because those extra funds are now locked away, where they can't be accessed should the need arise. With the all-in-one loan, however, they would have the mortgage paid off in under 9 years, and they would save close to $100,000 in interest over and above the original loan with paying the extra on it. If this is your first introduction to the all-in-one loan, I'm sure at this point you're wondering what's the catch. The power of the all-in-one loan is that it puts your idle dollars to work for you while still allowing you to maintain access to those dollars. In this couple's situation, their monthly deposits were $14,000 a month. Their average monthly expenses were $7,700, so 16% of their net income was left over. With the all-in-one loan, they can put that to use by having deposits lower the balance of their mortgage and therefore reduce the interest cost until they need the funds. They also had $75,000 in a bank account as an emergency fund where it wasn't earning them very much interest. Moving that into the all-in-one loan allowed them to still have easy access, but it put the funds to use, saving them interest costs. Thanks to the all-in-one, they were able to accelerate the payoff of their home, decrease the overall cost of financing. The loan provides a safe and efficient storage place for their idle funds. They still have 24/7 availability of those funds whenever they need it. And also, because of how the all-in-one works, their monthly payment is recasting automatically. As the principal balance reduces, so does the monthly payment obligation. This couple was concerned about giving up the 3.5% mortgage for a higher rate loan. But remember, mortgages are a math equation, and rate is only one part of that equation. Potentially more important is the time in debt and the amount borrowed. In their case, because of how quickly the debt was paid off, their effective percentage rate on the all-in-one was 1.338%. This is what we call 3D mortgage thinking. The top line represents the credit line limit they have access to over the next 30 years. And thanks to the paired checking account, that access is available 24/7. The next line is the declining balance if they kept their current mortgage and made the extra $500 a month payment. The bottom line is the balance on the all-in-one loan. You'll see the initial drop is when they deposited those idle funds. Other than that, they just cash flowed their life as usual and let their funds go to work for them. If at any time during this process they would have had a need for those excess funds that were working for them, they could have drawn them out of the account. If you're still thinking, this just isn't possible, reach out. I'm happy to go through it in more detail. I do also have a video about the mechanics of the all-in-one loan, and I'll leave you with this slide from that presentation. Like I said, rate is just one part of the equation that determines how much interest you pay on a debt. The other parts are the amount you owe and the length of time you're in that debt. You can see in this example, two parties each borrowed $100,000. But the person with a 6% rate saved over $18,000 in interest charges because that loan was paid off in 10 years versus the 3% loan over 30 years. The power of the all-in-one loan is that it uses your idle dollars to reduce your balance, thereby reducing your interest expense and ultimately shortening the amount of time that you're in debt. Want a review of your numbers to see if the all-in-one loan is right for your situation? Reach out. I'm happy to help you borrow smart.